Good morning, everyone, and welcome to episode 160 of the True Potential Do More With Your Money podcast. I'm joined this morning by Paul Durrant, Neil Rayner and Jeff Casson. And you'll notice that our regular host, Peter Bold, isn't in the room. He's in the building. You might see him wandering forlornly through the background here, staring in, wondering what he's done wrong, and we'll tell him that later. In the podcast today, we'll touch on banks, we'll touch on inflation and interest rates, but don't let that put you off. I think what we'll do is cover some interesting topics, and certainly this week has seen plenty of volatility in markets, and some of it, Jeff, triggered by what happened on Monday and over the weekend with Credit Suisse.
Yeah, it's certainly been 2 weekends of quite an important evolution in financial markets with, as we discussed last week, with Silicon Valley Bank, and then last weekend we had all of the news flow around Credit Suisse and the problems that they were experiencing ultimately, as we saw on Sunday evening, the Swiss National Bank, the Swiss government forcing together a merger, if we want to call it that, between Credit Suisse and UBS.
Yeah, were you surprised by the speed at which the regulator and the Swiss government acted?
I think we were all taken by surprise in the sense that they acted so quickly. So in essence, that's a positive.
Yeah.
Acting quickly to bring it together and avoid the potential broader systemic issues that may have come from that. It was the thing that gives you an illustration of how quickly they had to act was the changes to the laws that they had to make to ensure that the transaction could go through on Sunday evening.
Yeah.
But it was good to see that clarity, if you will, put around the situation, because over the course of last week it had become quite evident that there was more of a problem potentially building for Credit Suisse in terms of the deposit side of it. So it's not the fact that there was a challenge from the core liquidity measures that people have looked at. It was that actually deposits were just leaving the bank, and from a bank's perspective, that's never a good sign.
I think you've seen that also in the US. Following Silicon Valley Bank, you saw the Federal Reserve, the regulator, step in really quickly to calm markets, and you actually ensure financial stability, which is one of their objectives, and you've seen that reflect in equity market performance over the last couple of weeks, just improvement in sentiment.
And the volatility I spoke about just a few moments ago, we see this on a day-to-day basis because, as everybody would expect, we're watching things very closely. But the markets this week, between Monday and, as we're recording now, Friday morning, global equity markets are up.
Yeah, and I think when we look at the volatility, it's very much about what's been happening in the bond market, really. And that's certainly where it's manifested itself in terms of thinking about the expectation for interest rates and how the link between interest rates and the front end of the bond market. And certainly when we look at the 2-year yields in the US, they've been, over the past 2 weeks, really 2.5 weeks, they've been exceptionally volatile. Every day moving, and it doesn't sound like much, but it is in a bond land when you're seeing a 2-year treasury move plus or minus 0.2% every day. It's quite significant.
And with both Bank of England and the US Bank putting up interest rates this week, where do we see rates going, Jeff? Have we hit the peak yet?
Well, I think there's a couple of things that are tied into that, and really we're starting to see this divergence between where central banks are taking rates to versus where the market is suggesting rates are going. So I think from inferring from both of those things, we can say that we're probably much closer to the peak of interest rates and can look through to interest rates starting to come down. I think the key debating point really is, what is that timeline? So the market itself is looking for, if we look at the US for example, is probably pricing between 50 and 100 basis points of interest rate cuts over the next 12 months, whereas the Fed, when they spoke on Wednesday evening, I think we're trying to say, well, actually that might not just happen as you expect, and there's just pull and push between what the market's saying versus what central banks are having to say.
When I looked at the UK market this morning, so they put up interest rates this week by 25 basis points. The market's expecting them to increase interest rates by another 25 basis points, but then start to cut. So they're actually pricing a cut by the end of the year, just because inflation is expected to still high, but actually fall quite sharply as we get into the summer months due to those base effects kicking in.
Sure. And Neil, and from your side, dealing with clients each day, are you seeing an increase in activity of client calls and new questions really coming through?
I think we have also an increase, anytime the sort of market events, like, we're talking about the SVB Bank and also Credit Suisse as well. Not massively, I must say. There wasn't a huge increase. As we know, 2 weeks ago we've had a budget change. So there's more questions around that, and also because of tax year end.
Yeah.
So I wouldn't say it was specifically to do with the market and the events, but definitely it's ramped up because we've got that deadline moving towards April the 5th.
Yeah.
And some very important, investments for clients, and a lot of people who haven't filled up their allowances are obviously doing so right now.
And we've got evidence of that. It's almost an artificial deadline come 5th, 6th of April, the end of the tax year. But what we're finding on the technology side, clients are using both the app and their personal websites to put money into the ISA that they're holding if it's not fully subscribed, and pensions.
Yeah, I mean, it's very, very obvious for us that we talk about things like impulsive. It's not so much to people outside of this, building, because, we created impulsive. It was a world first. What's easier to do than to go onto your website, press the impulsive button, your ISA allowance can be filled up, or whatever you've got remaining left, by the touch of a button, which is taken straight from your debit card. So I think we take it for granted, but from a time saving and cost point of view, but also getting into the market at that particular time, there's no better way to do it.
No. And so far this month we're 3 times at the level of a normal month for money coming in via Impulse Save. Yeah. So the technology is being used, and it's working, it's convenient, and I'd encourage everybody to use that.
Well, we have seen record levels being Impulse Save this particular year.
And that's why we've got staff in, we're working extra hours, and we'll cover that later on in the podcast.
Yeah. And it's an interesting link if you think about that in the terms of what we've just been talking about banks and bank deposits. One of the things that is really advantageous to our business is the use of technology for clients to impulse save. The other side of that, with some of the banks, what's been a challenge is that technology has made it easy to move money around. So we benefit from money coming on to the platform as a result of that. But one of the things that we all have to be aware of is that it's very easy in the world of technology for deposits to move quite quickly within the banking system as well.
Yeah, quite. That's a very, very good point. And thinking now about the events that we've seen and the portfolios that we're managing, I know that you had the portfolio regular meeting this week, just gone. Decision was to make no change?
Yeah, so no changes to the construction of the portfolios over the course of the meeting. A lot of that coming back to 2 things really, being very much aware of what the market environment was in the background in terms of that volatility, but also recognising that, as we describe it, below the hood, the individual managers themselves making quite material changes within some of the portfolios. And by material, I mean moving back to their strategic asset allocation framework. So coming back to what is the core to how we think about multi-asset, where they've seen price moves being material, and we can think about that certainly within some of the bond markets. They've used that to rotate back into some of their equity markets, but very much around the strategic asset allocation. Others have made changes in terms of their bond allocation, also introducing gold into the portfolios as well. And from a growth aligned perspective, Paul, there's been quite a number of things that we've been discussing and changes working its way through as well.
Absolutely. I think as you point out, is we've just been moving back to model, just being very confident in the shape of the portfolio, in how we build portfolios to really manage through these periods of volatility, having global assets being diversified, but then just taking some opportunities as well where we've seen them. So we've seen quite a significant underperformance in the UK, in UK equity, so topping up there given the weakness. We've been allocating a little bit more to the US given its more quality focus, and typically does well when you see bond yields fall. But then adding to likes of gold, safe haven assets, but also adding to inflation-linked bonds in the US, which can do well if inflation proves to be continue to be a little bit higher than what you typically expect, but also if the central banks are close to peaking in interest rate hikes.
I think one of the huge advantages, Paul, that we've got is that clients' confidence in what we're doing is resulting on daily new cash coming in to invest. So your role as portfolio manager within the fund, you can buy what you want to buy when you see opportunities. You don't have to sell something in order to create
Absolutely,
that cash to buy.
Yeah, it's a real benefit, privilege almost as a fund manager to get those regular cash flows in each day. You can allocate where I see the opportunities, and it really does pay to have active management in periods like this that can exploit those opportunities.
And it's also about that focus on the strategic asset allocation framework that we work to, and really staying true to that, and that is, from a multi-asset perspective, that which is going to deliver the direction of travel that all of our clients need in terms of the return, but then using that to frame where we see opportunities, be it because of price moves or valuation opportunities that come through as a result of that.
Yeah, and the main advantage of multi-asset is exactly that. There's always somewhere to go. There's always an opportunity, and diversification comes through.
Yeah, absolutely. And, you know, I think times like this is why True Potential's philosophy is advanced diversification. You know, really helps smooth the journey for clients during these periods. We've had multiple periods over many years of spikes in volatility, and that's why we emphasise that.
Yeah, that's a good point. That's a lot of the conversations that we have with people who maybe are clients who don't know how the portfolios work. They don't know the makeup of it because, you know, they're not supposed to really be in that area. That's not their knowledge and their expertise. And we have those conversations about diversification, about what type of assets are in there and how that can change, but also react to the markets as well.
And it's been, I think from our perspective, it's been good to see over the past 2.5-3 weeks, really, the role that sovereign bonds have been able to play within multi-asset portfolios. Certainly there was at points last year where we were concerned about what was happening with sovereign bonds and the correlation with equity markets, and as we've seen, as we've had this problem, if you will, in the banking sector come to the fore, we've certainly seen sovereign bonds provide the bedrock within multi-asset and deliver positive returns over that period as well.
And that's really, you know, going back many years, gilt investment in the portfolio, that was the bedrock, the foundation upon which much of this was built. But the fact is that within the portfolios and the fund that Paul's running, he doesn't need to stay in the UK.
No.
You've been buying US treasuries this week.
Exactly. Yeah, I think it's the real benefit of being a global investor is you've got so many different opportunities to choose from, and UK gilts. We do hold UK gilts, but we clearly have more invested in the likes of the US and also European bonds.
And I think that brings to the other thing that we think about is the role of currencies, the role of hedging within portfolios, and certainly at the moment you can get a degree of a pickup from a yield perspective by going into US treasuries. Bringing that back to sterling is less onerous today, because the cost of hedging has changed quite dramatically as interest rates have not converged, but you've got the Fed at their 4.75 to 5, as Paul was saying earlier, Bank of England at 4.25. So interest rates are not that broad differential that we'd seen before. So that makes it attractive for us to look at these other opportunities as well for a sterling-based investor.
So if we think about what we were saying earlier about interest rates, perhaps not quite at the peak, but another 25 basis points should see us there, and that's 0.25%. Looking ahead to when we get to that peak and we start seeing rates coming back, what do you think the investment opportunities will be for clients?
I think it will open up different avenues within the asset classes that we look at, but I think clearly it'll be quite subtle within what it means for markets, because we'll come back and think about what are and where are valuations at that point in time, and that will be the important point from our perspective. Where can we find opportunities that are there based on valuation, and where that support is? It probably speaks to the equity content of the portfolios. That's probably one area where we would look to think about there, but that will be as we're looking forward. And I think this is the thing to always remember from our perspective, that the market's pricing some of these things already,
Yeah.
and that's already there in front and centre of the considerations that Paul and the team have when they're thinking about where to allocate capital today, because the market's a discounting mechanism. So we're looking to the future. We're trying to look at where those opportunities are and how they can be supported through that period of when rates can be cut.
And that kind of plays into something that was said in last week's podcast when we were asking about the effect of the UK budget on world markets, and it's kind of UK budget. You know, it has no effect at all. But what Neil was saying earlier again is that's a headline for clients thinking about their personal portfolios and their personal finances. The budget does play a part.
Mm-hmm. Yeah, 100%. We've had a lot of conversations about the budget in particular. I know it was covered obviously on the podcast last week, but there's been some great changes for clients, you know, with the lifetime allowance and pension changes and stuff like that, which means that the annual allowance has gone up, so 40,000 to 60,000 per year, which will come into effect not now but the next sort of tax year, which means that clients can put more money in. We have a lot of conversations as well about regular investing. We talk about pound cost averaging, which is, you know, putting that little bit of money in every month, so you're not taking a huge risk with a lump sum if you don't feel it's right for you, which is really important. And we've said on previous podcasts, and keep beating the drum, is if you set up a regular investor as early as possible, a regular direct debit, that's how you're getting these larger lump sums when you come to retire. And it's all about setting your goal, which is what we do with clients every day. And
pound cost averaging is exactly what Paul does within the fund, because he does have the daily cash flow and he can average it out. Yeah. You don't have to put it all in one go.
Yeah, good point.
And particularly when you think about the volatility that we're seeing in the background, pound cost averaging makes a great deal of sense.
Yeah,
that
absolutely.
Certainly allows you to navigate through those areas of volatility. I think going back to your previous question, Mark, as well, around how we think about opportunity, a lot of that will depend on how the economic environment unfolds as well. Because clearly at the moment, and as we saw earlier this week, we got the surprise with UK inflation coming in at the 10.4 versus the expectation that we would have got something in single digits. So there will be quite a lot to think about between the interaction of monetary policy and what that means for the broader economy as well over the coming months. And it goes back to something Paul was saying about just the US and the US banking system as well, how that plays through as well will be really important for how economic growth is and why or not central banks are cutting interest rates into the future.
Yeah, true, Jeff. And thinking about the inflation figures that we saw, they were higher than we expected, and the reasons for that were?
Well, a multitude of things really. A large part of it is food.
Yeah.
And I think that was probably, if we look at the headline level, that was a concern. But then when you dig into it at the core level as well, I think core inflation was 6.2 versus 5.8 sort of expected. So that breadth of the inflation impulse, if you will, was still pretty evident across large component parts when we take out food and energy. And that, I think, was what the bank were alluding to yesterday, and why at the start I was saying there's a challenge between what the banks are saying versus what the market's saying in terms of the direction of rates.
Yeah, I think just to build on that, just from what we heard from the Bank of England on yesterday even, was just that they were seeing that the growth picture for the UK was slightly better, the employment situation was slightly better, which means when we think about inflation, or the risk are that it could be a little bit more stickier, so that's why the market's still expecting interest rates to go up another 0.25%, to make sure that inflation does come down.
And I think, just to add to that, we had in the UK retail sales numbers this morning for February, which again probably surprised to the positive, much stronger than people had been expecting. Within that, it's quite interesting. You don't get the sense of, or you don't see whether people are switching between eating out and eating more at home, but there may be some of that mix starting to feed through into that and the strength of broader retail activity.
And we'll see energy prices wash through at some point. It hasn't quite hit there yet, but we've talked several times in the past about the peak of energy prices and where they are now and how much they've come down. We're not seeing that quite yet coming through in the figures or at the pumps, really, are we?
No, not really. I think we're talking about oil prices the other day, just how far they've come down at $75 a barrel now from above 100. So that decline will come through into the inflation numbers. The gas prices, particularly in Europe, have fallen markedly back to levels where we were in 2021. So it will feed through. It takes a while to come through in the calculations, but we'd expect that beyond May. Which is a positive.
And it was certainly interesting just listening to Andrew Bailey, the Bank of England governor, talk about that over the past couple of days, both yesterday and then this morning on the radio, basically trying to say to businesses that you have to look through some of this. You have to see that inflation will be falling, so don't be moving. And I think what he's suggesting is don't be pushing prices too much at the moment to try and capture this higher level of inflation, because as we look out 12 months, inflation could be significantly lower. And that goes back to the thing that we talked about quite a few times last year about the potential to embed inflation expectations into the future, and that's clearly a point of concern for the Bank of England at this point.
Yeah, and it's a good message when you think about it. If he's saying to businesses, don't look too far because inflation will be coming back. That applies to everybody in themselves with your own lives as well. That don't panic about inflation because it will start coming down. If it applies to businesses, it will apply to you personally as well.
Yeah, I think it's a good point. We do talk about that constantly with clients about, if we look at market events such as, the war with Russia and Ukraine, January 2022, it's a relatively short time ago. When we talk about goals, we're looking at medium to long term, 5 years plus, and everybody thinks that their goal's going to end when they retire. Well, it doesn't, because the pot's got to last them for the rest of their life. So it's a really important point to stress that these are short term periods. And we've all seen how the market reacts over the years, and that can give some confidence to consumers or clients.
Yeah, don't panic and raid your savings when you don't need to.
Correct.
Yeah. Okay. Coming back to Switzerland, and we talked about Credit Suisse. The regulator, the Swiss government, have asked UBS to step in. UBS are one of our investment partners. We've worked with them for a long time. Is there any need for any concern, or will UBS swallow Credit Suisse?
I think with anything any two businesses coming together, it does give you pause for thought and to think about what it could mean. I think when we've engaged, as we would, I think everybody would expect us to do, engage with UBS this week and speaking to the senior management team there about what it means for the asset management bit, the solutions part of that business that we work with. There is no overlap with the Credit Suisse business whatsoever. So from that perspective, we don't anticipate at this point in time any change at all in terms of the relationship that we have with the solutions team at UBS.
And in London, I believe there's about 7,000 UBS staff and 5,000 Credit Suisse staff. This is a major event in financial services in the UK. Yeah,
and there is overlap between those two businesses, particularly as it relates to the investment banking side of it. And I think that when we look at the reports that we've seen at the moment, there will be a degree of consolidation between those two entities at some point. But I don't think the transaction itself closes until the end of this year. So there's quite a period of time that we'll have to go through as this works through the system as well. But certainly from our perspective, it's one of those things that we will continue to challenge UBS on in terms of the provision and the resourcing that's focused in on the true potential portfolio solution. And they've been an excellent partner for us since 2016, and that will continue, which is what we expect really from an organisation like UBS.
Absolutely.
Good. It's a very busy head office, Neil. I'm looking at you because I know that your team are in today. They started at 8 o'clock. They'll be working till 8.
Yeah.
This is extended hours until...
Yes, yeah. So we've Wednesday was when we started the late hours. So we're open now from 8 in the morning till 8 at night. We're also opening up at the weekend as well. So we're doing 10 o'clock till 2 in the afternoon. just to provide clients with, you know, a bit of additional support really, and also running up to the tax year end. People might not have time to ring Monday to Friday. You know, people have got busy lives and jobs, so it's really important that we offer that extra additional support at the weekend as well, Saturday and Sunday. That's going to stop up until the 5th of April, so the end of the tax year. So clients, you know, can be calling us up until 8 every night, and also the weekends.
That's good. It's really the busiest, as we said before, it's the busiest period of the year for us.
It is.
From an administration point of view.
Yeah.
Not necessarily from the investment management point of view, but there's always things to keep us busy, as we've just covered in the last half hour or so.
Yeah, so obviously we started getting busy, you know, the last 2 weeks, so I thought I would take a week off and go to Jordan just to alleviate that stress on myself. But when I've come back, it's relatively calm at this moment. So clients can get an appointment anytime. They can, you know, we've got slots available now, so if you want to look at how it's going to affect you tax year end, it's really important that you give us a call, because you might want to fill up your ISA allowances. But I was just thinking, you know, about sort of reactive tools that we have. You know, we've just discussed before about impulsive. If you don't want to, you can go onto your app and top up yourself. Really important that, because you know, it will actually tell you how much of your ISA allowance you have left for the tax year. But like I said, on the 6th of April, it resets, it starts again, and then you've got new allowances, and also you've got new budget changes as well.
Absolutely, and encourage everybody to use those allowances while they're still here. We've got to take that and take advantage of everything that an ISA and a pension brings.
Yeah, 100%.
Okay, gentlemen, thank you very much. Enjoyed your company this morning. I know that you've all got work to do, so we'll get back to that. And to everybody out there, thank you very much for listening. Thank you for your support, and we'll see you next week.